You're listening to the Goldnomics podcast, with new episodes every month on iTunes, YouTube, and SoundCloud. Subscribe to stay informed. Hello and welcome to the Goldnomics podcast, where we look at global events through the lens of precious metals. And I'm joined again by CEO of GoldCore, Stephen Flood, and by Director of Research, Mark O'Byrne. And before we get into our podcast, I just want to remind everybody to subscribe on YouTube. You can also listen to us on SoundCloud, subscribe on iTunes and anywhere else that you may find us. And you can also stay up to date with all precious metal news by subscribing at goldcore.com. Our topic, the title of our conversation for this podcast is Attack of the Zombie Economy, How to Protect Your Assets. I'm going to come to you first, Steve. What is the zombie economy?
Wow, it's a new thing, I think, in modern economics. At least in the last 30 years, I think it comes down to companies whose fortunes are more related to the impact of official policy than anything that they do themselves within their own markets. So an example would be a company issuing, let's say, bonds at extraordinarily cheap rates because a central bank has deemed it in the public interest to buy those bonds and force down the prices, or force up the prices and down the yields to such an extent that that company looks much more bankable than it ordinarily would. So they are using printed money or new funds to purchase and intervene in that marketplace, changing the actual price, the value discovery mechanism within a market, and creating a narrative in order to suit their own, and I'd argue, political purposes, to kind of trick the market into thinking things are fine, that company is in fact fine. And what happens is it's just an example of the corrupting effects of unrelenting printed money washing through our economy. And there's lots of other effects as well. But essentially it denies people the ability to price risk and price return correctly, which is what the market mechanism is designed to do. And it kind of gets in the way of that and reprograms that. So you have these countries, these companies that arguably should go out of business, have no place being in business because they're not efficient. It ties up capital, it ties up human capital, which is actually probably the biggest long-term cost, and it also warps the competitive landscape and keeps in business, companies that should have gone out. And what you want in a proper functioning capitalist economy is creative destruction. You don't get that with a zombie company propped up by printed money from reckless bankers who don't have skin in the game in their own regard. They're not actually putting their money down into these transactions. You have an example there with large companies issuing bonds, using the money not to build factories or research and development, but to actually buy back their own stock. That's an example of kind of the effects of the zombie economy and zombie companies.
I suppose we are living in unprecedented times at the moment. This is a very strange moment in history that we're living through at the moment. We're still in the midst of this global pandemic, COVID-19 pandemic, with a lot of economies either in a strategic way starting to open up again. Some countries that have deemed to have dealt really well with the virus, other countries that have been deemed to deal with it not so well. But let's set that aside and just look at the economic impact going forward. I mean, we have seen the start of massive stimulus packages in the major economies, particularly in the US. And I suppose part of this conversation, what we want to do is to have a look and see what is the effect that the COVID-19 crisis and the response to it economically and financially is going to have on various different asset classes. And if we can kind of look at what's happening at the moment, what the response is being, and then extrapolate out from there and say, well, okay, this is potentially the effects that we can see on various different asset classes. And Mark, I suppose we could probably go across all asset classes and probably start first of all looking at cash and then stocks, bonds, property also, and cryptocurrencies, and then even obviously precious metals, tie it all back to precious metals. Now this might be a long conversation, so we may have to split it into two parts. But Mark, I suppose if we start off and talk about cash, and maybe you might just give a little bit of a background to the various different stimulus packages that are happening and the effect that that's actually going to have on cash.
Yeah, well, it's hard to keep up with there seems to be daily announcements from different governments around the world, and then the bottom line is you're talking about tens of trillions. I've seen different estimates from 10 trillion to 15 trillion, and a trillion. It's important for people to realise when they're discussing cash, and Stephen's talking about the printing of currency, and they're not even printing it today. They're just electronically creating these trillions of trillions. So what's the difference between €1 or $1 and £1, or $1 trillion, €1 trillion, €1 trillion? It's the only difference is they both have one in it, and then the trillions you simply type in the keyboard 0 0 0 0 0 0 0 0 0 0 0. I think I got the 12. If I get 12, so it's 12 zeros basically.
Yeah.
That's just a huge number, and that's what in 2 months, 3 months, that's what they've put into the economy, and they call it stimulus. We're stimulating the economy, and there is a degree, some stimulus, because they have put supports in place for the SME sector, which they should have done. They have put supports in place for people who've lost their jobs. They've given the social welfare and been quite generous in the short term, but long term that will be gone as well. So, but the stimulus is one thing, and we all agree that stimulus has to happen, and the governments need to spend money given the scale of the inflation and the economic contraction that we're seeing. But they're also bailing out. They're bailing out banks again. They're bailing out corporations, corporate America, corporations all around the world, the airline sector, even countries like Germany. Talk about bailing out Lufthansa. So that's the zombie economy. It's all these companies. We've been talking about this for years, that the level of debt in the world is astronomical at every strata of society, including in the financial sector and in the corporate sector. And a crisis was coming, as we knew, a massive debt crisis, and the pandemic, and more specifically the reaction by governments and the extreme lockdowns that we're seeing and shutting down our entire economies has precipitated brought forward this debt crisis that we're going to see. So the bottom line is, they're bailing out. What's happening is, whatever about bailing out banks, because we need banks. They're strategic, they're systemic. But they're bailing out companies that are shouldn't be bailed out at all. They should go to the wall. And as Stephen said, you need creative destruction. You cannot put the entire economy on life support, and that's what they're doing. They're putting even junk bonds now. They're electronically creating dollars to buy junk bonds. And Hertz Rent a Company is an example of a company that's under huge pressure, and it's been bailed out. A car rental company has been bailed out. And now you have BlackRock, one of the biggest investment managers in the world, and they're getting money, currency, dollars from the Federal Reserve, freshly printed or not printed, electronically created dollars, and they've gone in and they've actually bailed out their own investment vehicle where they have their own junk bond funds. So it's crony capitalism in extreme. It's quite corrupt, actually, but it's all been done under pretense of the virus, COVID-19, and this is a response to the virus, and that's total nonsense,
And they're also, as one of the things you mentioned there briefly, and just to explain it, I mean, they are not restrained or constrained by actually having to print cash. It is literally just a keystroke.
Exactly. So you can have infinite. We've long talked about this. It's Buzz Lightyear in that wonderful movie Toy Story. To infinity and beyond. You're creating currency on near infinite scales. And this has been seen throughout history, and it doesn't end well. So coming full circle, you're asking about cash. I mean, it just means that the outlook for cash is not good, but you have to be careful. Everybody needs cash, and cash is very, very important indeed, So I wouldn't say, and who knows, this massive inflation, stagflation, hyperinflation we're going to see, that may not happen for another year, 2 or 3 years, 4 years, 5 years, who knows? They may have to kick the can down the road a few years. So cash is a good thing to have because I think there's going to be lots of bargains, and we're going to talk about that looking at the various assets. So cash is an important part of your arsenal, but you don't want to be overweight cash, and you need to be very careful that inflation is going to kick off at some stage. And you also need to be wary of counterparty risk in banks as well. Just to finish out the point, the counterparty risk in banks, we've long talked about it as well, that potentially if banks get into difficulty, I think that obviously to be nationalised, some of them, but some of them may go to the wall, and then the deposits may be confiscated.
Would you not think cash is somewhat dangerous to have in a world where money's being printed at such a rate?
Yeah, well, I was making that point. So it's nuance. It's I wouldn't say it's dangerous to have. It's a good thing to have. Cash is king. I think gold is empire, and but the question is, when do we have inflation, Stephen? So if inflation, we have deflation right now, and I think that's going to kick in, particularly in the property market. I think we're going to see quite significant deflation there because there is a sort of a mini property bubble in the big cities around the world, and we will get into property in a second. So, but you need cash in order to your day-to-day expenses, obviously.
So beyond that,
and you need cash in order to acquire the assets because there's going to be huge opportunities in the coming months and years as we head into this depression.
All right, so you need cash in order for daily expenses, and you also need cash in order to pounce on good opportunities as this thing works its way through. Opportunities to buy things will present. Okay, fair enough.
Absolutely. Yeah.
So liquid assets is actually what you're talking about there, is not necessarily cash, but anything that can be sold in most market environments in a very liquid way, and allow you to jump in. Because I remember years ago, they used to talk about, you get these guys who talk about the stock market returns from the low point in a market correction, and they measure it out. They go, well, if you invested in stock in 1987, you'd have 15,000% and all sorts of stuff. But if you actually go 5 days to the left or to the right of that, you're actually at a much different number, and on a compound basis, your actual returns are a fraction of what is usually put as a headline. And people always underestimate. They make decisions on the basis of low points and top points in certain market cycles, but they don't realize at the time it takes to actually liquidate out of one investment, get your money, open up an account, get into the other one. And if you actually put those practical considerations in, you typically don't get to take advantage of market lows and highs as readily as people might think.
You don't with stocks, but you can with property and with residential and commercial property, and you can with land as well.
But you have to be liquid first, though.
Exactly. So that's where cash comes in. Yeah. You don't really want to be in stocks. I mean, stocks are highly liquid. You don't want to be in stocks if you're looking to buy property in the next year or 2 years, because you see there's going to be value in the property market.
But James, are we also when we talk about cash here, are we also not also talking about access to credit, really, as well? Because at this moment in time, if we're talking about stimulus, that's really it's an access to credit. All cash in effect is loaned into existence. So it's an access to credit, and it's which can be dangerous because who has access to that credit? It's not across all levels of the economy or all levels of society. It is those that are already wealthy. It is the companies that have access to credit. It is the money managers that have access to credit. And as this stimulus is released into the economy, it's done so in an access to credit basis. So it's who has access to that credit, and where are they putting that to use? Because it has a use.
It does. It's incredibly important. I mean,
without it, we will stagnate.
Yeah. But it's important. A lot of cash is actually, you're right, it's loaned into existence. It's actually usually it's anchored to an asset. So you pledge collateral, someone lends to you on that, and then they extend cash to you, which is created at that point in time and then used in the economy until you have somebody coming along and pledging an awful lot more money that wasn't attached to collateral. It's just a government pledge, which is an interference, and it then adjusts that original relationship of cash being lent off a collateralized asset. It's massively inflationary over time.
And then those that can, they either decide that they put it to use in the economy, or else they say, well, we haven't really, we don't see a viable home for this credit or this cash at this moment in time, other than certain asset classes. And I suppose one of the first ones we're talking about is stocks, because one of the strangest things in my mind that I've seen on the surface, before you kind of drill down underneath it, is we saw a massive sell-off in stock markets. And if we just take the Dow, I know it's not the only stock market in the world and not even the only stock market in the US, but if you look at a chart of the Dow selling off from what, over 29,000, close to nearly breaching the 30,000, and then the low point was what, 18? No, it was well below. It was 18,000, 18,000 odd. So massive sell-off. And then yesterday closed, it's not too far off 26,000. We've seen a massive rally back against the backdrop of economies that are kind of on their knees, have never had such an amount of turmoil thrown at them in such a short space of time since the Second World War.
Yeah, and arguably that wasn't even on a global basis like we've seen to this time. This is without precedent, and I hate to say this time it's different, but you look at that stock market change and change in trajectory. It's so acute, and you think the stock market doesn't seem to be connected to the real economy. There was some research done recently looking at pandemics and wars over 600 years they actually looked at, where over 100,000 people had died in economies, and they said that in a war situation your economy tends to bounce back really quickly as people put to work and have to recreate industry. In a pandemic, you don't have that effect. It actually can go for 40 years. You can actually have the negative effects of a pandemic. And the reason being is because you haven't lost your infrastructure, but you've lost an awful lot of confidence and a lot of balance sheet in your economy. People don't spend. They take time to come back to regain wealth again. And it has long-lasting consequences. And if you look at the local towns and cities where you live, and anybody watching this, you'll see that shops are opening up slowly, but even those that are opening aren't getting the kind of trend and footfall that they want. Things are kind of tender hooks still, and the stimulus packages are coming in and supporting the workers, and they have money, helicopter money now in their bank accounts for the first time I think ever in many economies, and yet the stock market is pricing in is priced to perfection, you might say, that everything's back to normal and perfect. I think actually, and it's a head scratcher, and everyone's scratching their heads. You look at all the major news reporters and news sources out there. A lot of market commentators are scratching their head, going, "What's going on with the stock market? How is it bouncing back? It's not a V-shaped recovery. It's not. We don't know." I think what's happening, and it comes right back to our original point, the zombie economy. If you look at the alternates for money at the moment, you have bonds which are paying nothing, if not negative. Like in Germany, Netherlands, Switzerland, you're actually losing money on their bonds, their 10-year bonds. So you don't have a real alternate there to put your money. So you'd rather put your money into the equity markets and hope that over the medium to longer term, it's going to right itself and you're going to get a return. So you do not have a level playing field here. Myself and Dave just before here we're talking about it, and it's like being at a bus station, and you have the equity buses going somewhere and you have the bond buses going somewhere, and overnight the Fed came in and they took out all the seats off the bond bus. There are no seats for you to go and sit on. You only have loads of seats on the equity buses. They put on more equity buses and everyone's piling in there,
and the bond bus is going nowhere now.
The bond bus is going to break down very soon.
It's got 3 punctures.
Yeah, exactly. And it actually takes you backwards. You actually get less for your money. You get less than you put in. It actually doesn't. It takes you away from where you want to go. It takes you in the other direction, and it's a complete perversion, all completely contrived by the actual authorities in the vain attempt to kind of right this thing. And this is like a wartime. We have to do things that we wouldn't ordinarily do. The chief economist of the ECB actually said this on radio today. He says, we're in times where we're doing things we wouldn't be comfortable doing in normal times, and it's an absolute endorsement of what they're doing is very, very dangerous. Potentially short term, there's an argument for it. I do see it, but long term, it's exceedingly dangerous. I would say that the Hertz thing that Mark mentioned earlier, I think it was, is interesting because you have people putting money into a stock market that's now winding its way up, not for valuation purposes, not for fundamental purposes, but because it's a price point that people are chasing now, and it's exactly what you see in a blowout scenario where you have a melt up. Marcus talked about this over the years before, a melt up scenario. You could see a stock market that's an awful lot higher as this money starts to go through, and people forget why they're buying it. They're just buying a name on an app on a phone, and it doesn't matter. The shares are actually technically worth nothing. I'm going going to bid it up to $6 from 50 cents and make whatever return on that. It's lunacy. You're going to see loads of these stories. Tesla 1,000 PE to 1. Imagine putting money into a stock and not getting it paid back for 1,000 years on the earnings. It's utter lunacy.
Yeah, I remember many years ago when I started out as a trader, and when a sage bit of advice I got from my old boss with respect to buying equities, which was the worst reason in the world to buy an equity is because you think it's going to go up, and on the surface you kind of go, well, what does that mean? And it was really about understanding the fundamentals. You don't just buy this because you think the price is going to go higher. You have to understand the fundamentals and the mechanics of what that company actually does. Has it got a good product? Has it got a good prospect? Has it got a good management? Has it got a good strategy? And is there
the intrinsic value?
Yeah, and what's the opportunity in the market? Are they matching an opportunity? And if you can tick all those boxes, that's a reason to buy the stock, not because it's going up. And you think, well, that's obviously the way professional money managers, the Warren Buffetts of this world look at this. They analyze the fundamentals of that stock.
Yeah.
But now what you have is you've got a market. Whether that's black box machines or what it is, and fundamentally they're trading the momentum here, and they're saying the reason I'm buying these things is because they're going up. And you mentioned something there anecdotally. You kind of said, look at what's happening in your own towns, and even in small seaside village where I live. Recently, I've seen the loss of a well-known restaurant. I've seen the loss of a well-known pub, and I've seen a national shop that had a large shop in the village moving out as well. So there is real loss to a local economy and real contraction.
And the SMEs as well, the backbones of our economy.
Yeah, 70%.
Meanwhile, the banks and the large corporations are being bailed out, and your point about credit as well. The credit is going into these large corporations and banks, and the Tesco's of this world are going to become even more dominant. So you end up with these giant monopolies, which is very, very, very dangerous. And we don't think of any anti-competition law whatsoever.
Yeah, you're seeing the billionaires get richer. And that's the thing. It's the access to that credit.
Well, this is
being able to take advantage of that.
This is what Ray Dalio, who I'm forever quoting, and I'm sorry to do it again. He talked about it this week, and he said, what you have is you're on a trajectory to a very, very nasty situation where you can have an awful lot of social disconnect and potentially war. It doesn't mean it's going to happen, but if you look at history, you have the ingredients. You have a global conflict between superpowers, China versus US. That's one of the big ingredients. You have a huge amount of inequality within society and a lot of discontent, and you can see that every single day. Look at the headlines. And you have a massive debt pile that's building at an extraordinary rate, and these three things really lead to conflict down the road, where you have a reset going on. And what he's saying is ultimately this doesn't mean it's going to happen, but if we make the decisions today to try to be more share in the benefits of society as we grow, because there's huge benefits to be had by working together and not going into a destructive phase of war and all these sort of things to work out these problems. But if you actually have a capitalist system that actually shares the benefits properly, which is what government is supposed to do, it's supposed to encourage growth and development and stuff, but then to share out the actual benefits to society and help raise the boats of all people. And they have not done that. And this is what the corrupting influence of printed money does over the long term. It enriches a very, very few people at the cost of everyone else, and they're actually they're undermining the entire system, which is very, very dangerous.
Yeah, they're creating the inequality. The central banks.
Cure is killing us.
It is absolutely shocking what's happening, and it's a continuum. This has been going on for years, but now before there was people asking questions and politicians would ask questions, and there was a bit of pushback in the media. People said, "Oh, is this right? Is this wrong? Should they be creating all these dollars and euros and pounds? So what are long-term ramifications?" Whereas today, nobody's talking about the potential ramifications of this. No. And your point about stocks, so the stock market can go up hundreds of percent from here, thousands of percent from here.
Yeah.
The best performing stock market in the world this year is Venezuela, and I think it's up 7,000%. But meanwhile, the currency is down, 99%. So that's what happens in hyperinflation. People, it's a crack up boom. They get out of cash and they'll buy anything that has intrinsic value. So a company that potentially has some form of cash flow is much more attractive than the devalued, debased currency. So
Yeah.
stocks are a very dangerous place to be, particularly if you're buying an index. Because the whole concept of balanced portfolios is, you buy your index of S&P 500 or MSCI World Index, and over the long term they tend to do well because capitalism tends to do quite well over the long term. But we don't have capitalism anymore. We don't have free markets. It's all been completely corrupted. It's socialistic actually what's happening. Or maybe it's even fascistic, because Mussolini called fascism is the alliance of state and corporate power. And today we have the state, which is supporting the corporations and the banks, and they're acting hand in glove. And meanwhile, SMEs, the backbones of our economy, and most dynamic sectors of our economies are being hollowed out, and we'll end up with a few giant monopolies who will work hand in glove with governments, and they'll harvest our data, and it's very dangerous from a whole host of different reasons, politically, economically, financially, but we need to join the thoughts in terms of, right, so how do we, these are the risks, how do we protect ourselves, how do we prepare against these risks, and the answer is, as it's always, diversified. It's quite simple, but it's not the balanced portfolio. I think that it's very important that we, that 60% equities, 40% bonds, that is for the birds, and anybody who is saying that is a safe way to invest in the current climate, I think it's actually irresponsible in the extreme,
So what we'll do is in part two, we're going to look at what we need to be doing looking forward. We'll probably have a look at cryptos, property market briefly as well, and also talk about precious metals. And let's see if we can reason where we think these things might be going in the future, so that people can start to at least make some informed decisions. But for the moment now, we'll just leave it there. And what I want you all to do is subscribe. Make sure you hit that subscribe button, and the notification bell.
Here's here. Where is it?
It should be down there.
Down there. High five.
And
High five.
and the notification bell, so that you get notified when we release part 2 of this discussion. But make sure you subscribe on YouTube, subscribe on iTunes. You can listen to us on SoundCloud as well, and you'll catch us. Subscribe on Facebook, and also subscribe to our market updates on GoldCore.com. But we'll be back very shortly with the second half of this discussion.
Great stuff.